You probably think smart people make smarter financial decisions. That high IQ protects you from scams, from emotional investing, from bad money choices. But reality says the opposite. Some of the smartest people in history lost fortunes chasing terrible investments. Doctors drown in debt. Engineers fall for crypto scams. Harvard graduates panic sell stocks at the worst possible time. And in 2008, some of the most educated financial experts on Earth nearly collapsed the global economy. So what's going on? Why do intelligent people make catastrophically irrational financial decisions? The answer is uncomfortable. Because intelligence doesn't protect you from psychological bias. Sometimes it makes those biases even stronger. Your brain likes to believe you're rational. But behavioral psychology shows that most financial decisions are emotional first, logical second. Today, we're breaking down the hidden psychological traps that quietly destroy smart people's money. The first reason smart people make bad financial decisions is overconfidence. And ironically, the smarter you are, the more dangerous this becomes. Researchers discovered something fascinating. People who believe they're highly knowledgeable often overestimate their understanding dramatically. This is called the Dunning-Kruger effect. Intelligent people are often better at constructing convincing explanations for bad decisions. Imagine two investors losing money in the stock market. The average person thinks, "I made a mistake." The intelligent person thinks, "The market just hasn't realized I'm right yet." That confidence feels rational. But psychologically, it's often just ego wearing a suit. The brain hates admitting it was wrong. Behavioral economists discovered something deeply strange about human psychology. Humans experience the pain of losing money almost twice as strongly as the pleasure of gaining it. Your brain hates losing. This completely distorts financial decision-making. Imagine buying a stock for $500. A few weeks later, it crashes to half its value. Logically, you should ask, would I buy this investment today? But psychologically, your brain asks something very different. How do I avoid feeling like a failure? And suddenly, the decision isn't about money anymore. It becomes about pain avoidance. This is why people hold terrible investments for years. Why gamblers keep doubling down. Why people stay trapped in failing businesses. And why intelligent people sometimes lose the most money of all. Because intelligence helps you rationalize emotional attachment. Now let's talk about one of the most dangerous biases ever discovered: confirmation bias. The human tendency to search for information that confirms what we already believe. Once your brain commits to an idea, it starts filtering reality. Imagine someone becoming convinced that a cryptocurrency will explode in value. Suddenly, every positive tweet feels important. Every optimistic YouTube video feels trustworthy. And every warning feels biased. The brain quietly builds an information bubble. And intelligent people are especially vulnerable because they consume more information. But more information doesn't always create better decisions. Sometimes, it simply creates stronger delusion. Your brain isn't searching for truth. It's searching for emotional reassurance. And modern algorithms make this even worse. Social media platforms learn your beliefs and feed them back to you, over and over again, until confidence starts feeling like certainty. Now comes another trap almost everyone experiences: the sunk cost fallacy. This happens when people continue investing in something purely because they've already invested too much to quit. Money, time, effort, identity. Imagine someone spending years building a failing business. Deep down, they know it's collapsing. But walking away feels psychologically unbearable, because quitting means admitting, "I wasted years of my life." So instead, they keep pouring money into failure, not because it makes sense, but because humans struggle to emotionally detach from past investments. And intelligent people often suffer from this even more, because they become emotionally attached to the narrative that they're too intelligent to fail. The final trap is the illusion of control. Humans desperately want to believe they can predict uncertain systems, especially intelligent humans. Studies show that small successes in random environments can trick people into believing they possess real control. This explains day trading addiction, gambling behavior, risky investing, speculative financial bubbles. A few lucky wins convince the brain, "I understand the system." But markets are brutally humbling, because randomness feels personal, and humans are terrible at separating skill from luck. This is why during financial bubbles, everyone suddenly feels like a genius, until reality arrives. So why do smart people make terrible financial decisions? Because intelligence isn't the opposite of irrationality. Emotion is. The human brain was never designed for modern financial systems. It evolved for survival, for tribal belonging, for emotional protection. Not stock markets, not credit cards, not algorithmic advertising. Which means your greatest financial threat usually isn't lack of intelligence. It's psychological blind spots you don't realize exist. And maybe the most dangerous thought a person can have is this: I'm too smart to be manipulated. Because the moment you believe that, your brain stops questioning itself. And that's when the real mistakes begin. If you started seeing your own behavior in this video, that's the point. Subscribe to Natural Glitch for more videos exploring the hidden flaws in human behavior, decision-making, and modern psychology. Because humans aren't rational beings. We're patterned glitches.